Say you've managed to save $10,000. That should feel like progress. But after a while, another question starts bothering you. What are you actually supposed to do with it? Because keeping every dollar in cash forever means most of that money barely grows. But moving the entire $10,000 into stocks tomorrow sounds reckless too. This is where people get stuck. They learn how to save money, build up a decent balance, then leave it sitting there for years because nobody explained the next step. So let's go through the actual transition from saving to investing, in order, without gambling with money you might need. Having $10,000 saved does not mean you have $10,000 available to invest. Some of that money already has a job. Rent, bills, a car repair, a trip you're taking next year. Emergency expenses, any money you expect to need soon, should generally stay out of the stock market. Stocks can drop right when you need the money, so instead of asking, "How much money do I have?" ask, "How much of this money can I leave untouched for years?" Let's say you have $10,000. You decide $6,000 needs to stay available for emergencies. Another $1,000 is for something you're buying later this year. That leaves $3,000. That's the money we're talking about investing. This one decision prevents a lot of beginner mistakes. Because the problem usually isn't that someone invested, it's that they invested money they couldn't afford to leave invested. Before investing aggressively, keep a cash buffer. A common target is around 3 to 6 months of essential expenses. If your necessary monthly expenses are $2,500, that could mean somewhere around $7,500 to $15,000. Your number depends on your situation. If your income changes every month, you may want more. If you have a very stable job and low expenses, you may be comfortable with less. The point of this money is simple. If your car breaks, you lose your job, or some random $2,000 expense appears, you don't have to sell investments to pay for it. Imagine the market falls 20%. If you have emergency cash, annoying but manageable. If you have zero cash and suddenly need money, now you're selling during the drop. That's why your emergency fund and your investments should be treated separately. One protects you from short-term problems. The other is meant to grow over the long term. This is another reason people stay stuck in savings for years. They think investing starts when they have $20,000 or $50,000. It doesn't. You can start with a small amount, $50, $100, $200. The first goal isn't making huge returns. It's learning the process. You open the account, transfer money, buy the investment, watch the price move. See what happens when your $200 becomes $194 for a few days. That sounds insignificant, but it matters. Risk feels completely different when you're experiencing it instead of reading about it. Starting small lets you get comfortable without turning every market move into an emotional crisis. Then you can increase the amount later. Before buying anything, you need somewhere to invest. For most people in the U.S., that usually means a retirement account, a workplace account like a 401k, or a regular brokerage account. Don't overcomplicate this. If the money is specifically for retirement, tax-advantaged retirement accounts are worth looking at first. If you have a workplace plan with an employer match, understand that before ignoring it, if you want more flexibility with money that isn't specifically for retirement, a taxable brokerage account may make more sense. You don't need to open 5 accounts. Pick the account that fits what the money is for. And remember this because beginners mess it up all the time. Putting cash into a brokerage account does not automatically mean that cash is invested. You still have to buy something inside the account, which brings us to the part people make way more complicated than necessary. Open any investing app, and you'll see thousands of things you could buy. Individual stocks, crypto, options, sector funds, leveraged funds. Whatever company happens to be trending that week. As a beginner, you do not need to start there. A broad, low-cost index fund is one of the simplest things to understand. Instead of betting heavily on one company, You're buying exposure to many companies through one fund. An S&P 500 index fund, for example, tracks hundreds of large U.S. companies. A total market fund can spread your money even wider. That gives you diversification immediately. If one company has a terrible year, your entire portfolio isn't dependent on that one company surviving. Does that mean index funds can't fall? Of course they can. If the overall market drops, the fund drops too. But you aren't trying to guess which individual company will still dominate 20 years from now. You're buying a broad piece of the market for someone trying to build long-term wealth without turning investing into a second job. That's a much easier system to maintain. This is probably the easiest part. You've already learned how to save. You were moving money out of every paycheck, so don't destroy that habit. Redirect it. Suppose you've been putting $500 a month into savings. Your emergency fund is now full. Instead of continuing to pile every new $500 into cash, maybe $100 keeps going toward short-term savings and $400 goes toward investing. Same paycheck, same saving habit, different destination, and automate it. Every payday, the money moves automatically. Then the investment gets bought automatically if your platform allows it. You don't need to sit there every month asking, "Is today a good day to invest?" Because nobody consistently knows that some months you'll buy when the market is expensive, other months you'll buy after prices have fallen. Over time, you're simply investing at regular intervals instead of trying to predict every market move. This is commonly called dollar cost averaging. And for normal people with jobs and bills, it's a lot easier than trying to trade the market. Let's say you invest $300 every month. We'll use an 8% average annual return purely as an example. Markets obviously don't give you exactly 8% every year. After 1 year, you've contributed $3,600. The growth probably won't look impressive. That's normal. In the beginning, most of the account is your own money, but after 25 years, that same $300 per month at a hypothetical 8% average annual return would grow to roughly $285,000. You contributed $90,000. The rest came from growth. That's why compounding feels almost useless in the beginning and ridiculously powerful later. The larger your balance gets, the more money your existing money can potentially generate. At $10,000, an 8% year is $800. At $100,000, it's $8,000. At $500,000, it's $40,000. Again, that's an example, not a guaranteed return. The important part is the scale. Early on, your contributions do most of the work. Later, the portfolio itself can start doing a much bigger share, which is why waiting 10 years because you want the perfect time is usually more damaging than starting with a small amount and learning as you go. If you're going to invest in stocks, accept this before your first purchase. At some point, your account will be down, maybe 5%, maybe 10%. During a major market decline, possibly much more. That's part of investing. The dangerous moment is when someone sees a drop and suddenly changes their entire plan. Let's say you've invested for 4 years, the market falls. Your account is down 20%. You panic and sell. Now you have another problem. When do you buy back in? While the news is still terrible. Most people won't. They wait. Then the market starts recovering. They still wait because they're worried it might fall again. Eventually, prices are much higher, and now they feel like they missed it. This is why long-term investing works better when the money you're using doesn't need to be touched soon. If your goal is decades away, a bad month, or even a bad year, means much less. You keep contributing. And when prices are lower, the same monthly contribution buys more shares. You don't have to enjoy crashes. You just need to expect them. Starting small is fine. Staying small forever is where progress slows down. Maybe you start investing $100 a month. Then you get a raise. Instead of letting every extra dollar disappear into a more expensive lifestyle, increase the investment. $100 becomes $150, then $250, then $400. You don't have to jump from zero to investing 30% of your income overnight. Build it as your income improves. This is where saving and investing start working together. Your saving habit creates the money. Your investments give some of that money decades to grow, and each time your income increases, you give the system more fuel. You start by building savings, then you separate the money you'll need soon from the money you can leave alone. You keep enough cash for emergencies. Once that's covered, you open an investment account that fits your goal. You start with a simple diversified investment. Then every month, some of the money that used to pile up in savings starts getting invested automatically instead. You keep doing that when markets are boring. You keep doing it when markets are ugly. And as your income grows, you increase the amount. That's really the transition. Saving is the stage where you create financial breathing room. Investing starts once you have money that no longer needs to sit around waiting for your next emergency. The mistake is thinking you have to choose between the two. You need cash for short-term security, and you need investments for money that's meant to sit there for years. Once you know which money belongs where, the whole process becomes much simpler.